After the excellent sessions last week in terms of the business plan and project planning of your business, we're going to go through what I'm calling the 3Fs. So the frameworks, finance and funding for your business and business ideas. And this really builds upon, and every session will kind of build on the knowledge that you gained in the previous session. And the way I think I'll do this one is feel free to ask questions as we go through, and I'll answer them kind of on the fly. We've got a nice tight group here today. So I think so long as that's okay with you, Kumar, are you okay if we just take questions throughout?
Sure.
Yep. Okay, cool. All right. So let's go. So this is really what I want to talk about today. So I want to talk about business structures. And when I'm talking about business structures, the way I like to think about it is the house for your business. This is what's going to kind of wrap around your business, keep your ideas safe, your IP safe, your financials safe, and really get that structure right. We're going to recap on the business plan and the business planning process, though a bit nervous following last week's session on that, because I don't know about you guys, I found that incredible and really, really insightful in terms of really taking the essence and the real important aspects of a business plan and really being able to distill. I'm going to kind of take that business plan idea and that top line framework and talk through some of the things that you're going to want to put in there from a next level down, more detailed level that you can use operationally within your business, as opposed to using it to pitch or to kind of framework your ideas. We're then going to talk about the revenue model. So essentially how you're going to make money, because every business needs to make money, if you think, I know we've got not-for-profits here as well, even if it's only to fund itself. So really important no matter what kind of business you're running. I'm going to talk a little bit about financial models and financial reports, and I'm going to take you through the 3 types of financial reports. And now some of you may already be familiar with some of the terminology. If you're not, don't worry about it. I'll take you through them. I know we've also got kind of varying levels of financial acumen within the group. But please, if the information is not clear to you, please ask questions. And equally, if you want to go kind of next level down in terms of the information, please also shout out. Then we'll talk about profitability. There's the phrase that revenues for vanity, profits for sanity, which I like a lot. Then talking about through some of the ways that you can fund your business idea. And then finally, we'll wrap up with a bit of a now what? You've got a plan. Now, what are your next steps from a concrete perspective? Sound good? I'll take that as it is.
Just while you're at it, Michelle, in terms of asking our questions, do we just raise hands or interrupt you? I'd prefer the previous one, of course.
To be honest, I'm perfectly fine with interruptions. But if you feel like you can't quite get your moment to speak up, just use the emoticon hands up.
Okay.
And I'll try and keep an eye out for them. If I miss one, please, one of the other mentors just holler at me. Because I may be in full flow and getting distracted. So either works for me.
Thanks, Michelle.
Cool. Let's get into it. So these are broadly the 4 structures that you can house your business in. And I'm starting with this slide because I think it helps in terms of contextualizing why you would maybe look at these different structures. So you can either, and I'll go into exactly what these different structures are in a second, but I want to kind of take the top level view first. So we've got sole trader, We've got where it's just you in the business, running the business. You've got a partnership where essentially that's the 2 or more person version of a sole trader. You've then got a company, and then you've then got a trust. And as you can see from the arrows on the slides there, really what those 4 structures broadly do in accelerating order is, if you go from sole trader to trust, sole trader is kind of the cheapest option. The trust is the more expensive option. You then have varying levels of complexity between the sole trader from a setup and operational perspective to the trust, which is the most complex. However, you win some, you lose some. There is less flexibility on the left-hand side than there is as you transition towards the right-hand side. And what we primarily mean about flexibility there is the flexibility of how you take the profits out of the business. And that's really what we mean by flexibility. And then also asset protection. So there are different ways in which you can protect your assets. And it really goes to kind of lightest protection to kind of most detailed kind of protection of your assets to that kind of company trust side of things. So apologies for the busyness of these slides. We will circulate these slides afterwards, but really what this grid does is talks to the different aspects of these 4 structures. So what the structure actually is, what you should expect in terms of setup costs, what we mean by complexity, how you want to think about liability, and that's around your personal liability, how those profits split, and again, that's where we kind of get to that concept of flexibility, and then tax, and generally how the tax works against those 4 structures. Now, really important, glad this is being recorded, this is not tax advice for you, okay? I'm going to take you through the general concepts of each of these structures. So this is not personal tax advice, and it is not personal legal advice either. It's really important that you get the right advice for you and your personal circumstances, okay? But this will help you go into those conversations with advisors with a bit of a clearer idea in terms of what you're asking and a bit more context in terms of the structures themselves. Does that make sense? Cool. Okay, so I'll go through kind of vertically the columns and shout out if anything's not clear. So first we're starting with the sole trader structure. And really here, essentially all you're doing is setting up an ABN for the business. And so it's registered as a business, but there is no legal distinction here between you and your business. You are your business, and you're legally responsible for all of those aspects personally. The plus side is when you're starting out as a business, this may be the quickest way for you to get started. It's very simple. Getting an ABN takes a matter of minutes. There's very little setup costs. I think, when I'm talking to businesses and founders about how they might want to start up, if you're just trialing a business, and also this is probably more relevant for maybe professional services businesses or businesses where it's just them, this may be the most appropriate option for you and your business because it's really simple. But the problem is here is that is around kind of the liability of you/your business, okay? So your liability with respect to this business, and you can get insurance to help protect yourself to some extent, but you've got unlimited liability. And because there's no separate structure that your business is housed in, your personal assets could be at risk if things go wrong. That's a worst case scenario. Some businesses aren't risky. And that's why, again, this framework might be the right one for you and the business you're experimenting with. In terms of the split of the profits, well, there's nothing to split it with because you are your business. There is no distinction between those two things. But that also means that you are personally liable for all of the tax on your net income. So if you think about when you do your personal tax return, all of the revenue and costs for your business will go into that same tax return. It is just the one thing. And that is essentially kind of the sole trader setup. Any questions so far? Okay. Partnerships, it's similar to a sole trader.
There's a grey bar to raising hands, sorry.
Oh, sorry, I didn't see. Yes.
He's putting up a bit of a show as well.
Just quickly, before we move on, is it correct also to say that as a sole trader, you can't have employees?
Yes, because you can't run a payroll as an individual. You could engage contractors to come and work with you on your business, but they're not. It's a really
employees.
It's actually a bit of a complicated question because there is very little distinction as far as the ATO is concerned between employees and contractors, which is a whole kind of minefield in itself. So it's something to bear in mind, and it's why a sole trader structure is probably best for literally you as a sole trader, and that's why it's probably most appropriate if it's just you providing your services as an individual. Whether that's copywriting, whether it's IT services, whether it's tax services, that kind of thing.
Well, as opposed to running a shop, for example, and having staff. Exactly.
Anyone else? Okay, so a partnership is very similar to a sole trader setup, apart from, as its name implies, you have a partner or partners. So again, it's slightly different in terms of liabilities because you can set up under a partnership agreement more of a legal structure around kind of who's responsible for what within that business. So if you imagine you kind of split yourself in two, you can agree with the left hand does this and the right hand does that, and it has some legal standing so long as you have a formal legal agreement in terms of that partnership. Again, it's relatively easy and expensive to set up. The main additional thing will be around having that clear kind of legal agreement in terms of the partnership agreement. There are minimal reporting requirements, but there are some differences in state legislation when it comes to governing partnerships. That's just something to be aware of. Again, with the liability, because you have a partnership agreement in place, there can be some distinctions between what you're liable for compared to your partners, but it's still not a separate legal entity. So that's where you really need to be quite careful. Split of profits, again, will come down to this partnership agreement. And in terms of tax, each partner will pay tax on the portion of that net income that's attributed to them. But again, that will be part of your personal tax return. Okay. Then we come to, and I think probably sole trader and company are the ones most people are most familiar with. A company is where you kind of start putting more of a framework around your business. It is a separate legal entity. As far as the law is concerned, your business exists separately from yourself as an individual. Now, that has higher setup costs. It still can be relatively inexpensive. I mean, not sure what's happening on my screen there. It still can be relatively inexpensive, but you will need to actually either buy an off-the-shelf company or set up a company. You'll have compliance costs relating to that company setup. You'll have some administrative obligations. and legal obligations under the Corporations Act. The really key difference here, as you start to move through these different structures, is that as a shareholder, and I'm assuming you would be a shareholder within your company, you're not directly liable for your company's debts. However, and there is a caveat to this, if you are a director of the company, which for most of us here, if you were setting up your own business, you would be a shareholder and you'd probably be a director as well, okay? Unless for some reason you were barred from being a director, because not everybody can be. For example, if you've been declared bankrupt in the past. So as a director, if you breach any of those responsibilities under the Corporation Act, you can be personally liable again. Split of profits. Profits are distributed in relation to your shareholding. So, for example, if you held 100% of the shares, 100% of the profits would go to you. If there was somebody else that held shares within the company, for example, if you've raised funds, those profits would be distributed in proportion to the shareholdings. So you can't choose how to split those profits. And those profits will be distributed via dividends. And that's just what we call the mechanism for distributing cash out of the business. Bobby?
Hi, Michelle. Yes, thanks. My question at this point is, you mentioned like the company, when the directors are liable for if anything happens in the company, right? So is it just one director or all the directors?
So all the directors have obligations under the Corporations Act to act. Broadly, it's to act in the best interests of the company.
Right. And shareholders wouldn't be a part of that.
So no, shareholders aren't responsible in the same way. It's the directors of the company that are responsible.
All right, thank you.
So if you think about a scenario, for example, where you founded a company and you've gone and raised some capital, whether it's from friends or family or whether it's through a formal capital raising round, those people that you've raised money from probably, let's assume in this instance, aren't going to be directors. So say it's still only you as a director, but now you have, for sake of argument, 5 other shareholders who own a proportion of that company. Because they're not directors, they don't have the fiduciary responsibilities under the Corporations Act of being directors. Those responsibilities, and it's not the same as having kind of personal liability for the debts of the company, but they will have responsibilities.
Thank you.
Does that make sense?
Yes, it does.
Yeah, I mean, I think George is on the call today, and he would say underneath that, if you've ever kind of taken a peruse through the Corporations Act, there's a lot of stuff in there. And so but there's a whole section on what the obligations of directors are. So, it's probably too big a topic to cover off in this session. But just broadly to understand that the reason why I talk about the director's responsibilities is I think there can sometimes be an assumption that because you've set up a company and it has its own legal structure and kind of legal personality, you can kind of absolve yourself of responsibility if everything goes wrong within the company. That's true to a certain extent, so long as you behaved as a director in the best interests of the company. That's the distinction. So if you kind of started, doing things that were for your own personal gain and weren't in the interests of the company, you would actually run into some trouble. So it's not quite you can set up a company and then you can do what you want. People try.
Michelle?
Yeah.
Hi, I have a question around incorporated.
Yeah.
I've been looking at whether I should set up as an incorporated. I don't quite in this model. Where does it and how does it work?
You're talking about a company.
It's the same, exactly the same as because I understood incorporated organizations like football teams and church groups who will do fundraising, and they will accept funds and donations and even earn some money. It's under a completely different tax model or something. So it's different. I understood it to be different to a company.
So you can have but this is probably where my legal knowledge kind of drifts a little bit. But as a not-for-profit, you can incorporate as a not-for-profit entity, and that might be what you're talking about. But there are some distinctions, but generally, when we talk about incorporating, it's a company.
Okay.
I know the terminology sometimes is a little bit confusing indeed. And when we talk about corporate, certainly is referred to company. When we talk about incorporation, and when we're dealing with NGO, non-profit organization, when we call it incorporate, for example, if you look at the OA's constitution as incorporate, in that case, the OA is not registered as a limited company. It's just like you're right, it's not a company. But at the same time, when we use the term incorporating, and that in that case, that also have the meaning of a company. And but generally speaking, the short answer is if we say the non-profit organization incorporate, and in that case, that non-profit organization is not covered by the corporate law. And the difference is if non-profit organization covered by the registered company, limited company covered by the corporate law, in that case, that company basically can do the fundraising nationwide and whole Australia. But if registered as a incorporate, for example, we look at OA constitution, and in that case, when they do the fundraising, they have to follow the law in New South Wales, get the permission in New South Wales. If they want to do the fundraising, for example, in other states, they need to get approval and in those states. So that's have some kind of a different, but certainly also have some more detailed difference, and we can discuss maybe later.
Yeah. Thank you so much, George. And this is why you have a lawyer as a mentor. The regulations around kind of not-for-profits and fundraising specifically can be quite complex and probably kind of deeper than this session, but happy to chat about that online if you want some guidance or want pointing in the right direction to get some further information.
Thanks.
Then we also have trust structures, which my background is from the UK, and we didn't talk so much about trusts in relation to businesses in the UK, but it's quite common here that trust structures will hold business operations. And so the difference here is there's a trustee which holds the business for the benefit of the trust beneficiaries, which sounds like a nuance, but it is actually quite important in terms of, particularly in terms of who holds the liability and how business profits are distributed. You know how I had that structure where we kind of had we had least to most flexible and least to most in terms of the asset protection. This is where the trust structures kind of come into their own in terms of the distribution of business profits and being as creative and flexible as you can about exactly how you repatriate funds out of your business to yourself or to the trust beneficiaries. And quite often what people do is kind of they set up family trusts, and so then they can utilize all of the members of their family and their particular tax situations most effectively. So it becomes kind of a tax planning strategy. Interestingly enough, if you're looking at tax news or anything like that. At the moment, discretionary trusts are coming under quite a bit of scrutiny from the ATO because they know that's why people are setting up the discretionary trusts, and they've flagged that they're going to start scrutinising these setups in a lot more detail now. None of this has been passed into law yet, but what they're trying to do is basically, I think they've described it as using, sorry, I've just seen a couple of hands up. Let me just finish that thought, then I'll come to the hands. In terms of the trust structures, I think the phrase that I saw most recently was using your children as money mules. And what they mean by that is that, for example, if you've got a child living in your house and you've passed income from the business down to your child, and then your child pays you rent, what the ATO are flagging is that kind of structure they're going to start looking at, because that money actually comes back to you. It's just going in a bit of a circular route. Like I said, none of that has actually been passed yet, but it's one reason why just have a think about your personal circumstances when you're going into this. Bear in mind that rules do change, and bear in mind that just because your friend who set up their business a year ago has this particular structure does not mean it's good for you. So please make sure that kind of when you're getting the advice in terms of setting up your business, you're actually getting professional advice. Talking to your friends and network is great, and it gives you a broader view, but it's important that you look at your own personal circumstances. Sorry, I see a couple of hands. So Anshul?
Right. So my question is around the tax component. So I wanted to open a company while I keep my own job. So the tax obligation gets impacted if my company is making loss, or if my company starts making profit. So if I'm trying to extract profits from the company as a salary, I'm already getting a salary from my employer. So do I pay taxes combining both, or we are saying that
okay, so at a very top level, and it depends on the detail of how all these things work, at a top level, your company is a separate thing from you. And so in terms of your tax returns and your tax, for example, say your company's making losses. Well, that company has no tax to pay, okay? The salary you're receiving from your employer, you'll be getting your taxes deducted kind of through normal payroll there. However, if your company is paying you anything, so whether that's fees or whether that's a salary, so say it's paying you $1,000 for the year, you have to that's a deduction to your business, so that will be minus $1,000, but your personal tax return will show income of $1,000. Now, the distinction there could be your company could be making $10,000, but it only pays you $1,000 because it's got other expenses. That $10,000 that the company's making in revenue has nothing to do with your personal tax return. It's only what's you're actually getting paid by your company, whether it's director's fees or whether it's consulting fees, or that's what you would get in your personal tax return, or you would put in your personal tax return.
And on the flip side, if we are filing a loss, let's say we invested in the company and we're not unable to run the business, and at the end of year we realize that all our investment has gone to vain. So would my salary taxes will also gain that impact? I can claim taxes?
No, because again, they're completely separate. Your company is a completely separate legal structure. So the fact that your company has made a loss, it will just accumulate those losses. That doesn't get set against your personal income.
And if I do a sole trader, then would the loss, I would be able to claim taxes of that?
Yeah, so all of the revenue, well, it's not so much claiming back, but the net income, so the revenue less the cost, the business expenses of your sole trader business would be part of your personal tax return.
Okay, cool. Perfect. Thank you, Michelle.
If I can just add one thing there quickly, Michelle.
Yep.
as a sole trader, you're going to claim the revenue of the business, but you're also claiming the expenses of the business. So if the business has made a loss, the expenses are going to be bigger than the revenue.
Yeah.
So that loss carries through to you. A company like a proprietary limited has the ability to hold the money. It's called retained earnings. So if they don't distribute it to you as an owner, for example, as dividends, whatever, as Michelle said, you don't pay personal tax on it, but the company does.
Perfect. Thank you. And
that also means that those retained earnings and that kind of money that business is generating is the company's money. And so you can't have it sitting in your bank account, for example. Otherwise, you start getting into, a particular kind of tax issue where, the ATO starts looking through those structures. There's one other point that I just want to raise, which it's particularly important in terms of businesses who are providing services to kind of just one client. It's something called personal services income. So where you've got more than 80% of your revenue coming from one source, the ATO doesn't like that. The ATO starts looking at that and going, hang on a minute, I don't think this is a real company operating a real business. I'm going to tax that like that's personal income. So that's just one thing you've got to be a little bit careful about. But that's probably kind of getting too granular for today's chat.
Yeah, for sure. I'm sorry, I just got a follow-up question with that. Since I'm starting up, as we discussed, the sole trader might be the right thing to go with.
Yeah.
We can keep the structure. Let's say if we are making profits and we see we have tested the business is doing good, we can change it to company after a while, is it?
Yeah. Yeah, you can.
Alrighty, cool, perfect. Thank you.
Michelle, just a question. So I know it's a company that you have to open a separate bank account for the company to do all the transaction. What about sole trader? Do we have to also have the different bank account for the business?
Honestly, for your own sanity, I would, because you would find it. I would find it incredibly difficult to do my tax return at the end of the year if I wasn't keeping my business revenue and costs separate. So not everybody does it, but I honestly don't know how they stay sane, but because it doesn't need to be particularly complicated, right? You just have to have a separate bank account. And, if you're using credit cards within your business, a separate credit card that only business expenses go on. Because when you start mixing personal and business expenses, life gets very complicated. It's possible to do. It's not illegal. It just is it's more of a headache than you necessarily need to take on.
Yeah.
And
Okay.
you spend ages getting it all sorted out again when it comes time to file your taxes.
Or worse, you're going to pay someone to sort it out for you. Tafiq?
Thank you, Michelle. Michelle, my hand was raised a while back, so I'm kind of...
sorry.
No, it was just the only reason I mentioned that because my question's a little outdated at the moment.
Okay.
It was more to do with the company structure that we were discussing, that I kind of needed a bit of a rundown on, where we have different type of directors as well. We've got executive directors, we've got non-executive directors, and shareholding directors and stuff like that. So at what levels do liabilities change or increase? I don't need to get into the nitty-gritties of it, but just an overview of what kind of director calls for what sort of liability. And the second part of my question is more related to what Sarah raised up again as well. In the advent of social enterprises becoming the new thing, are we at some stage going to be covering the structures and the requirements for NFPs, whether be it private or association or however? That's something which was the second part of the thing. Yeah.
Okay, taking the second part first. No, I wasn't intending to go into detail on social enterprises and not-for-profits. It's only because most of the people that are going through this program aren't doing a not-for-profit or social enterprise. Apologies to those of you who I know are on the call that are. And also it can be, it's quite a complex area. As I said to Sahara, we can definitely kind of point you in the right direction in terms of getting more information, if that's your intention. But no, I wasn't going to cover it off in this session.
Sure. And yeah, in that case, just a bit of a rundown of the different directors and how the liabilities change, just an overview.
So from a really kind of simple perspective, if you're registered as a director with ASIC, you are on there as a director as far as they're concerned. You are a director and you have liabilities. I think we've got to be a little bit careful in terms of terminology, because sometimes people call themselves kind of non-exec directors but aren't actually formally directors. They're part of an advisory board. If you're part of an advisory board, you don't actually have fiduciary duties. And so if someone asks you to be a non-exec director, or you are asking someone to be a non-exec director and expecting them to actually, be a formal director, just be aware of what you're asking them to do. And that's why, you have directors insurance as well, because it's becoming, to be completely honest, it's becoming more of a risky territory for people, because the law will come after you in terms of your responsibilities. And so maybe George can pick up, is there, from a legal perspective, a difference between if you're a director who's operationally involved in the business versus a non-exec director? But my understanding was, sitting there and saying, well, no, I wasn't really involved in the business, I'm a non-exec director, is really not going to give you much of any protection as far as the law is concerned.
Yes. I totally agree, and because when the issue is really happened, the court or the lawyer side, they will try to get evidence, see and who will be this person truly involved in such kind of business arrangement. Because sometimes that also happens. For example, one company is registered under the name one person A, but actually it's controlled by person B. In that case, and once we got concrete evidence to show the person B's involvement, and the person B will still reliable for that. That's one example. Another example is sometimes, for example, when we're dealing with a multinational company, the parent company, they also have the subsidiaries, but the parent company actually they have hasn't really. But some subsidiaries is under control of parent company, and also those subsidiaries registered as independent limited company because it's controlled by the parent company, for example, and they use the same bank account or even just like same employee member and work for both parent company and also subsidiaries. And if subsidiary got problem and both subsidiary company and the parent company will be liable. It's not just simply say your name is not on the list, you're 100% no liability. It's not that case. Yeah.
And one thing, Sahara, as you want to do incorporated, you can talk to me later on, and I can take you through as I form Opportunities Australia as an incorporated organization, so I can talk you through.
Thank you. That would be wonderful.
No worries.
Sorry to be butting in there, but Kumar, I might make use of that opportunity if it's still on offer.
A bit late, but yeah, I'll try to push it.
Thanks, man. Please try.
It's what we're here for. Anshul and Tafiq, I'm not sure if you had another question or whether your hand was still raised from before.
Yeah, mine was just more of a follow-up on what Anshul mentioned, and Ray covered on that as well. So personal income, personal loss based on a sole trader loss will give you no tax relief in your employment case, right? That's
no, the other way around. If you're a sole trader, you and the business are the same in terms of your tax return. It's all on your personal tax return. There's only a distinction if it's a company and you.
Oh, I'm sorry. I was kind of relaying it from Anshul, where I'm actually doing a job, and I am paying taxes there. So I don't because I've incurred a loss on sole tradership. That's not something which is going to be helping my income or lowering my tax slab with the employee that I'm employed with separately. In the case where I'm also employed in a corporate company and doing a sole.
Sorry, can I just, that's backwards. That's what I was trying to clarify.
Mm-hmm.
As a sole trader, your business losses and your personal income is under the same umbrella when it comes to your personal tax return. So if your expenses are higher than your income in your business as a sole trader, that goes on the same. So effectively that loss will reduce the income that you're getting from your employer when it comes to your tax return.
Oh, okay, great. So the fact that it's on a TFN and an ABN doesn't really matter, because once
an ABN doesn't have any impact from a tax perspective.
Okay.
Because you can get an ABN as a sole trader, and quite often you'll be required to get it as a sole trader if you're working for clients, for example.
True. All right. No, thanks for clarifying that.
All good.
And just one last question from us as well. So just from the liability perspective, I was just wondering from sole trader versus company. So if, for example, my startup is an online grocery store, so I'll be hiring a delivery driver, so contractors, but then if something happens to them in an accident or something, like they fall off their vehicle while they're driving off to the customer, so am I liable? Like what is my liability there, and is there any insurance, or what kind of things I can do as a sole trader versus company to protect myself from this?
Yes, you can get insurance, but I'd suggest, again, caveated with this isn't tax or legal advice, that your business is probably, the setup of your business is probably complicated enough that you would want to set up as a company rather than a sole trader.
Okay.
So you're saying like liability can be on company in that scenario versus on our personal lesser to really cover the compensation, correct?
Yeah, well, and also if you're going to, again, we would be getting into a territory of kind of employees versus contractors as well, and particularly in terms of kind of gig economy type contractors. The law and the ATO are all over that right now. So I would definitely, for that type of business that you're talking about, I would be putting as much legal protection around myself and the business as I could.
Okay.
A simpler way of thinking about the liability in terms of consequences is, for example, if you bought up a load of stock and the company couldn't pay for it, and you had assets like a car or a house, they could be seized to pay off those debts. That's a very one of the most common examples of why you'd want to separate out between a company and your personal liability. Because if you can't pay the debts of your business, if the business can't pay its own debts, your assets are up for grabs.
All right, that makes sense.
Cool.
Okay.
Thanks, Michelle.
No worries. All fun and games starting a business, isn't it?
Indeed.
Cool. Okay, I will move on. Okay, so just to go back in terms of the business plan now, and I'm conscious that what we got from Billy last week was very much kind of that high level helicopter view in terms of the business plan and really distilling out the essence of it, which is really important. But, if we explore that idea a little bit further, there are a few other uses of a business plan. And so when it comes to kind of why you need one, primarily that business plan is for you. You've got kind of the high level roadmap, which is what Billy was taking us through last week, in terms of who you are as a business, what your objectives are, how you're going to achieve those objectives. But you also have external users of those business plans. So, for example, if you want to go and raise any money from a bank, for example, or potential investors, they probably want to see at some point, and maybe not in the first discussion, a more detailed business plan in terms of exactly how you're going to achieve what you're going to achieve. And also, if you're starting a business for the first time, quite often, beyond the focusing your thoughts and kind of providing that touchstone, it will become kind of your operational roadmap that you can kind of keep referring back to, and understanding kind of what the pillars of your business are. So that's when you start getting down to kind of the more detailed business plan. Any questions? No. So when you're talking about a detailed business plan, and Sahara, I don't know if this is more of what you were expecting kind of in last week's session. So detailed business plan, you're going to be looking at things like the executive summary, which is the thing you write last, the industry overview, who makes up your industry, who are the other players within your industry, where do they fit in terms of the competitive landscape. You'll be doing that kind of market analysis. You'll be looking at your SWOT analysis. You'll be building out your sales and marketing plan. You'll be working out who you need to run your business, because you can't do everything. You will do at the beginning, but ultimately you're going to need specialists within different areas to actually execute on your plan. So what's your team going to look like? What are your logistics going to look like? How exactly are your business processes going to work? Particularly if you're a product-based business, and if you're thinking about the grocery type business that we're talking about earlier, how do you buy your stock? Where do you store your stock? How do you safely transport your stock? These are all the things that you'll think about in terms of your logistics plan. The technology your business will need. Starting a business now is very different from 10 years ago when, all of these amazing cloud-based CRMs and kind of tracking tools and financials and a whole raft of different project management tools just weren't available 10 years ago. And now all of these tools, which were historically only available for large corporates, are available to every startup, and generally for quite a cheap price as well. So working out what your tech stack is, even if you're not a very technical business, should be part of your business plan. And then looking through your through your risk and legal framework of your business. And for some businesses, that will be relatively light touch because you don't have a very risky type business model. And with some businesses, there is going to be a lot more to consider, particularly if you're relying on people within the business to actually execute. So delivery drivers, for example. And apologies for keeping on using that example. Tafiq, did you have a question?
No, I didn't. Thank you.
Oh, sorry. I thought your light was on. There are lots of resources available for kind of the more detailed business plan. Kumar, did we see Billy's circulated after last week? Apologies if I missed an email.
Sorry, his slides?
Yes. I think he was going to circulate the framework.
Yeah, we did circulate. I did send it out.
Oh, sorry, I must have missed the email. So you've now got those slides, which is kind of the high level view, which I think is really, really important for distilling your ideas. But then there's a number of resources available for kind of detailed business plan templates. A resource that I go back to quite often is business.gov.au. And they've got a number of really great resources and templates and tools on their website, but one of them is the business plan template. So if you haven't found that website yet, I encourage you to go and take a look.
Hey, could you share the link or just let me know again?
And we'll circulate these slides again afterwards, so you'll have it. But can I do this now? No.
Hi, Michelle. Bobby here.
Yeah, hi, Bobby.
Sorry for the background noise, but
okay.
Just can you touch base on what is the SWOT analysis?
Sorry, I should not use acronyms. So SWOT is strengths, weaknesses, opportunities, and threats. And the way to, when you're first doing this, it can quite be quite easy to merge kind of strengths and opportunities and weakness and threats. And the way to kind of differentiate between the two is strengths and weaknesses are kind of internal factors for a business. Opportunities and threats is almost kind of what comes at you kind of from the outside externally. So, strengths, for example, might be skill sets that or unique IP that you have within the business that is a key selling point for you. Thank you, Emil, for sharing that. And opportunities may be changes in market trends that are going to benefit your business. And so that's the way to distinguish between those categories.
Thanks, Michelle.
Okay. Any more questions on the business plan before I move on? No? Okay. Let's start talking money. So revenue model. And this is going to be relevant for most types of businesses. And just to give full credit, this is not my kind of nice graphic. This is a framework that was developed by someone called Ron Meyer, who's a professor of strategic leadership. And it breaks down exactly what we mean by a revenue model, exactly what are those individual elements, because I think sometimes when you think about revenue, it can feel quite obvious or quite clear. But when you really think about where the value is within your business, and that goes to kind of what you're selling, there's actually a little bit more to it than that. So if I start in the yellow section, for what is paid. So what are you actually giving to your customer that they are going to pay for? And that can be, as straightforward as an item or product. And that's probably the most tangible thing we can think of. But then you can also be selling, and this will be relevant for people that are thinking about, for example, a membership model or a course, for example. It can be access to information or access to a group that have the same objectives. And then also when you're thinking about outcomes, if you're providing a service, you may only charge on a result. You may only charge, for example, when you get someone a certain amount of sales or leads, when you deliver a certain project, a tangible result as opposed to kind of a thing, a physical thing. Does that make sense? Then we can look at how you're paid. And so you can get paid on, per thing that you sell or per project that you deliver, or you can get paid on a recurring basis for something that, and this is probably more relevant for access to information or access to a group, where you're getting paid a license fee for something that someone can use in perpetuity or for a certain period of time, or a subscription where they're kind of continually getting updates and improvements to this thing that they're buying for you, or a retainer, where they're giving you a certain amount of money each month and you agree to do a certain kind of set of things. So they're all kind of different ways in terms of how you get paid. As a sidebar, where this starts to get interesting is, potentially when you think about selling your business eventually, because businesses, typically businesses that can show good recurring revenue, ideally with locked in contracts, get higher valuations, so a higher price for the sale of the business. So that's something that, you may want to think about as you're building out your business, because it's something that potential investors will look to as well. So not necessarily when you're going to eventually sell your business, but if you're looking for investors on that journey. Okay. Then the how much you're going to charge, and there are reams and reams and reams of analysis and research and theories in terms of pricing models and pricing strategies. You have to think about, is what you're selling your thing or your service for, is it profitable? So is your business actually making money? And we'll go into that in a bit more detail in a second. Then you have to think about, skipping to the third bullet, you may actually be selling something particularly initially that isn't profitable, because what you're wanting to do is to scale your user base. It's a strategy that you need to carefully think through, because sometimes it can be difficult to increase your prices later, but it may be a strategy you employ, and it's certainly a worthwhile consideration. And you've also got to think about, the ongoing. So, if someone buys a lot of what you're selling, you're going to give them a discount. If you think about wholesale pricing, for example, that's the model this is all built on. But for any business, you may want to consider, if someone comes back to you multiple times, well, you might give them an incentive to do that. And then also, of course, with the competitive landscape, what your competitors are selling for. Caveated with, I think it's a very dangerous and dubious strategy to try and be the cheapest in the market, because, to use a very overused phrase, all you'll end up in is a race to the bottom, because there will be some people that are very strategically pricing to subsidize growth, but have no intention to keep pricing at that level. But you need to know the range in which your competitors are selling, because if nothing else, what that's going to help you to do is differentiate your product, so you understand, or your customers understand, why what you are selling is at a premium, or why they can't directly compare it to something else. Then the who pays. And so this is an interesting one, because it isn't always obvious who pays for something. One example that I like to use is a client of mine who's a digital marketing agency. And what they do is they provide marketing services for IT resellers. Okay, so you have all of these IT resellers, and they provide the marketing campaigns for these IT resellers. The IT resellers do not pay a single penny for this. The people that pay are your Dells, your HPs, your Lenovo's, because they know that they need to sell their products through these IT resellers. These IT resellers do not have sophisticated marketing engines, and so they will quite happily subsidize and sponsor these marketing campaigns so that their products are marketed effectively. So it's just one example of, it's not always who you might think is the customer that's actually paying for the product or service. And then the what's paid. And again, the best example to use here is around kind of data and free products that you use, because you can pay, you can pay in a very transparent way for your product or service by paying dollars. And as we all know, kind of our Googles and Facebook /Metas, you're paying with your data and your information, because they're farming that to sell to the advertisers who are their customers, not you. And so, that's where you get the, if it's free, you're probably the product. So, and that's that business model there. That kind of takes us around the wheel of the revenue model. Any questions?
Shall I have a hand raised there, if you don't mind?
Oh, sorry.
All right. So coming on to the how much is paid section, the way I understood that was more like what your first 2 points of what is profitable and market pay are essentially your anchor points, and the remaining 2 are more like a justification to those first 2 anchor points. Could we reverse that? Are there pricing models which are based on subsidized or anchor points as subsidizing and discounts, and then kind of figure out later? Would that be even a good approach to start with?
There are multiple different ways of thinking about this, but my thinking is that you have to start with what's profitable, because even if you don't sell at a set profitability, you need to know what's profitable in order to decide you're undercutting it. Otherwise, how do you know if $1 is subsidizing for growth or 50 cents is subsidizing for growth? You need to get those financial metrics well understood within your business, and they'll evolve over time, to be clear. As your business grows and changes, this is in no way, how you set your pricing isn't a set and forget strategy. There are multiple factors that are going to influence how you price your business and how you price the products within your business.
Sure. So in a sense, profitability and market analysis or competitor analysis would be the first go-to points of setting up your pricing structure, and then you use subsidizing and discounts to kind of justify if you don't want to go with that initial analysis.
I'd probably phrase it slightly differently in terms of, subsidizing for growth, discounts to encourage volume or kind of repeat customers are strategies. Whereas, what's profitable is really kind of your financial cornerstones. And what the market will pay is basically information that kind of forms part of that profitability and that pricing strategy.
Sure, makes sense. Thanks for clarifying that.
But that isn't the only way of thinking about it. Does anybody else have any thoughts on that, particularly the mentors or people that have launched businesses before? Have you priced your businesses or priced your services? Don't be shy. Okay, I'll sorry, Ray.
What I was going to say is, when you talk about the marketing, one of the critical decisions you have to make around product pricing is where are you positioning your product in comparison to the competition.
Yep.
If you have a premium product, you're going after a different segment of the market than if you have a discounted product. And companies can ruin their perception as a premium product by cutting their price.
Yeah. And a lot of it, exactly to that point, a lot of pricing strategy is around psychology. I use an example that happened. I was chatting to someone week before, and the guy runs a website agency, and he runs a very successful website agency. And he was saying to me, and he was kind of bemoaning the fact that, he often gets clients coming to him that have been completely ripped off by kind of cowboys that have built websites and built them completely unfunctional, or kind of didn't listen to the brief, et cetera, but kind of charged them an arm and a leg for it. And so these poor clients who have really bad experience with their first provider come and sit down with him. He kind of talks them through everything and then gives them the price. And he says it's amazing how often these clients will be put off because they think my price is too low and then wonder if I really know what I'm doing. And he's like, but I feel like it's a fair price for what I'm offering. And, you know, there's nothing wrong with, but you know, he runs a very successful agency and, you know, he's obviously a very, very ethical businessman. But it was just interesting how, you know, how people's responses to your pricing can be very counterintuitive sometimes. So yeah, there's a lot of psychology involved beyond the actual financials of it, which is kind of why I would always start with, you know, you've got to know how much your product or your service costs you to buy or to produce or, you know, to make. And then you can start putting the psychology and the strategies around it. But if you don't know that in the first place, I have no idea how you build a pricing strategy around it. But that's maybe because I'm a CFO.
Yes. Can I just add, you need to look at the fully delivered price.
Yeah.
You can manufacture it and put it on your shelf.
Yeah.
But if somebody is expecting you to bring it to their house and install it, you've got a whole other layer of costs you have to account for when you're comparing your cost to your price.
Absolutely. And thank you, Ray, for a segue into a later slide there. I'll be coming back to reference that. Okay. All right. So I'm not going to go into a huge amount of detail on financial models because I don't want to lose everyone at this point. But I think it's really important for you to understand what the three different financial reports are. Because again, with the terminology, some of this terminology, particularly around P&Ls, profit and losses and cash flows, they can get very mixed and very blended. And it's really important to understand kind of what the differences are between them. And then you've got kind of your balance sheet, which ties the two things together. Because understanding it will help you do two things. One, it will help give you credibility when you're actually talking to potential investors, but also it will help you understand your business and understand how to make your business viable, because there is categorically a difference between your profit and loss and your cash flow, and you need to understand kind of those two differences in your business. So the profit and loss shows the profitability of your business, and it completely separates it from, and I'll show you an example, by the way, after this, and show you how different the two things can be. But it separates the profitability of your business from exactly when the cash is going to come in and the cash is going to go out. And it's, for the long term, it's the profitability of the business you need to understand. Okay. However, if you don't understand your cash flow, you will never get to that long-term business, okay? Because the cash flow has killed many a profitable business, all right? You need to understand how your business needs to be cash flowed, because the timing of when you need to pay certain things, whether that's paying things in advance or, for example, you know, your tax bill at the end of the year, because we hope you all have successful and profitable businesses. You're paying the tax on that business, or, you know, if your business is registered for GST, you're paying your GST quarterly. And if you've spent all of that money on stock and you don't have enough money to pay the ATO, you're not going to have a business. Okay. And so that's why it's really important to understand those two things. And I'd say when you're starting your business, it's the cash flow that's most important, okay? Because that's really kind of where you're going to give your business enough time and enough oxygen to prove itself, and work out, you know, the profitability of the business. Because like I said, there's been many a profitable business that's died because of lack of cash, which feels very counterintuitive, but I promise you it's very true. The balance sheet is probably the financial report that you'll look at the least, But I think it's really, really important for you to understand what a balance sheet is and why it's important, because if you don't understand all of these three financial reports, at least to a top line, the reports you get from your bookkeeper or your tax accountant are going to make no sense to you. And with the balance sheet, what essentially that's doing is showing you, Ray referred to retained earnings before. Retained earnings is what sits in your balance sheet and kind of, we hope, builds up over time, okay? It's almost like, I'm going to confuse you now with cash analogies, but it's almost kind of like your bank account that kind of slowly builds up in the background. But your balance sheet will also show you how much you owe. So, for example, when I'm talking about that linkage between your profit and loss and the cash flow, the money you owe to the tax man, or the money you owe to your suppliers, or the money your customers owe to you, will kind of be the connective tissue between those two reports. Do I still have everyone? Tafiq, is that a new hand raised?
Yes, it is this time. Yes. Michelle, this is going to be more like a cheat code that I'm asking of you, but is there any available software like Xero or MYOB sort of a thing, which would kind of give us a forward insight into what your cash flows are looking like? Any recommendations?
Yeah, okay. So there are lots of tools out there that help you do this. Xero is, one of the most common. As you're starting out your business, it's not necessarily the cheapest. There are other options out there. But it's the one I use to run my business. It's the one that most clients use. It's a very intuitive tool. Any what we call GL system, so general ledger system, the entire ethos is based on things have to balance. So you put one thing here, there has to be an equal and opposite kind of entry over here. And those entries will flow through your profit and loss on your balance sheet, okay? And any of those softwares will do that for you. And all of those softwares will be able to show you a profit and loss, a balance sheet, and a cash flow summary.
So it's an old age, I think, the double entry system that we'll be following. In terms of numbers, and I come from an artistic background, so numbers are not really the best of my friends. So the moment I see on a page many numbers, I've already put off. So would you have anything recently that you've used or come across which would be a little more graphically enabling for the likes of me?
Yeah, I mean, there are other tools. For example, you've got, I'm trying to think of the names. So Spotlight is one I use. Futurely is another one. That I probably wouldn't suggest that it's worth using at a very early stage of the business, to be completely honest. Xero does give you some graphs and dashboards at the front of the screen. It actually has the opening page, which you come onto for your company, is called Dashboard. Mm-hmm. It's not very pretty, but it does show you kind of some of the inflows and outflows. Mm-hmm. One thing that I will talk about a little more at the end, though, is when you're starting a business, you're going to have to wear multiple hats. You're not going to have to understand all of them, you're not going to have to be an accountant, but you are going to have to understand your numbers. You're not going to have to be kind of like a SEO specialist, but you are going to have to understand, how your website functions and kind of what marketing is. You may hate kind of walking up to strangers in the street, but you are going to have to sell your business to some extent. So you are going to have to talk about it, and you are going to have to sell your wares in some way, shape or form. And depending on your background, depending on your personality, you're going to have differing levels of comfort with each of those hats. And I know a lot of people kind of, particularly, I work with a lot of creative clients. We work with a lot of marketing agencies, advertising agencies. But you do need to kind of have basic understanding of your financials, it's really not that scary, I promise. Just spend some time with the numbers and kind of, what I encourage people to do is if you have a friend that's more comfortable with numbers than you are, kind of talk to them. There's lots of resources, there's lots of podcasts, there's lots of books that kind of really break it down to a much more digestible level. My pet hate is finance and tax people that kind of try and make everything sound very, very complicated. It seems to be more kind of the ego of the professional than trying to explain it, because essentially, as you were saying, and you kind of nailed it when you opened, right? It's double entry, which confuses some people, but you know exactly what that is. If you put one thing here, you've got to put something else here. It's as basic as that. Things have got to balance. If you take one thing out, you've got to put something else in. So I just encourage you to spend as much time as you can familiarizing yourself. There's no magic trick. So yeah, I don't know whether that was helpful or off-putting.
No, it's all good, all good. I mean, I've had a bit of a misadventure with commerce and marketing and finance as well, so I kind of understand what you're saying. But yeah, thank you for those recommendations, though. I would be looking at some. I haven't really come across yet. I mean, I've used MYOB. I've actually created a white paper for my own accounting software as well. But the thing that I...
Hold on a minute, did you say you weren't comfortable with finance? Have you done a white paper on accounting software?
Yeah, I do it because I can do it. I don't like it.
Okay, fair enough. I'm not listening to you anymore. You're all over the finances. You don't need me.
Yeah, I'm more worried about basically looking at it at not about spending that much time in looking into figuring out where. I mean, I could balance it out with sundry expenses, but balancing is not the idea. It's about analyzing where things are, where things can go wrong.
Yeah, I know what you mean. Jokes aside, I know what you mean. It's the interpretation. Yes, we know mechanically one thing in, one thing out, but I call it the so what. Okay, I'm looking at the numbers. So what? What does it mean?
Yeah, absolutely. Yeah, you get it out now. Yeah,
cool. Any other questions? Okay. So this is my attempt to kind of really explain what the difference is between a profit and loss report and a cash flow. Okay. So if you focus on the left-hand side here, this is the cash view of your business in, say, any given kind of, let's call it a month. Okay. Oh, hello. And well, let's say this is a bookstore. Okay, so you've got your cash sales here of $2,000, and it's a very simple business. When someone comes to buy a book from you, they'll just give you the cash for the book. But then you employ people in your bookstore, and so you have to do your payroll that week or that month, and you're paying out $400. Because they're quite cheap, the people you employ. But the rent's due this week, and so you're having to pay out $600. And then insurance is also due for the year, so you're going to have to pay out your insurance. And then you're going to have to buy a couple of computers. Let's say that you've got 3 new members of staff, so you've got to buy 3 new computers in your bookstore. I'm not sure why they all need computers, but they do. And then it just so happens that, you had no utility bills to pay. They come quarterly, didn't come this month. So where you run through, though, because you've had to buy these computers, maybe you shouldn't have bought the computers, you've actually got a cash outflow for that month of negative $3,200, okay? So you lost money as far as that side of the page is concerned. But did you really? How profitable or otherwise was your business that month? And that's when you move to the right-hand side. So same sales. So the people came in, they bought their books, they gave you the cash, you got $2,000 in your till. But you may only have paid out $400 in terms of your payroll, But actually, and you'll know this from your pay slips, kind of working for employers, you have your gross wages, but the employer will keep a certain portion because it's their responsibility as an employer to pay that out to the ATO. Well, when you're a business, that money that's sitting there, it's not yours. You may not have to have paid it out that month, but it's not yours. So when you think about the profitability of your business and how much those wages cost you, you have to include the whole lot, including the portion that's going to sit on your balance sheet, which you owe to the ATO at the end of the quarter. But you win some, you lose some. The rent paid, even though you physically paid out $600, well, the amount that relates to this particular period is only $200 because you pay your rent every 4 months. So actually for that month, it's only $200. Your insurance, you may have had to pay out your insurance for the year, but when we think about how we spread that cost across the year, you're effectively using that insurance 1/12, 1/12, 1/12. You don't use it all in 1 month, and then it benefits the business for the entire year. And that's why from a profit and loss perspective, we only count kind of that month's usage of that insurance. Your computers, we're saying you're going to use these beautiful computers that you bought recklessly in 1 month over 3 years. So actually, when it comes to a profit and loss, you'll spread that cost over the whole 3 years that you're going to use these lovely computers. And then from a utilities perspective, and we've picked on electricity here, you may not have had to have paid any electricity bills this month, but you certainly used electricity. You had the internet, you had the lights on, you air conditioned the place. And so there is a real cost to the business of that. And so when you work through all those flows, though, with all the higher costs of the wages, but then the lower and the higher costs of the electricity, which you didn't pay, but the lower costs of the things that you had to pay out from a cash perspective, but you used over a larger period of time, well, actually, your business made money that month. But it's exactly the same business, okay? In exactly the same month with exactly the same activity. But this is why you need to understand your cash view of your business and the profitability of your business. Because short term, if you can't fund a month like this, you're not going to be able to run a profitable business in the long term, okay? But you've got to make sure from a profitability perspective that you are making money kind of longer term. And so that's why you're focusing on the P&L on the right-hand side, but on a funding and a more short-term side of things, the cash view. Does that make sense?
Can I just chime in and say this is exactly what I was looking for in a software format?
Cool. I shall try. Yeah. So you will. So for example, you will see this in Xero. Okay. So the cash view of the business you'll see in your cash summary in, say, it's Xero, and the P&L view you'll be able to pull a P&L report, and they will not look the same. Okay, and they will not look the same for good reason. Xero also has some good functionality now, which does a level of cash flow forecasting for you. So, for example, if you've got people on payroll, it will actually show you kind of when you have to pay those bills to the ATO, for example, so the portion of the wages that you've withheld. So Xero does do that to a certain extent. It's not perfect. I don't love it in terms of its cash flow forecasting, but it certainly it tries, and it's better than the softwares used to be.
You can only get what you pay for.
Sorry?
You can only get what you pay for. So yeah, Xero does that enough at its level. I think it's not one of the more expensive ones.
Well, I don't know. I'd say kind of for a small business, kind of it does start to get up there, Xero. There are definitely cheaper options out there, but I think that, and Xero knows that it's got a devoted user base, so it does now start inching its pricing up. Mm-hmm. But I think that what a software isn't going to do is help you interpret the numbers. And that's where, through a mixture of, advisor and kind of consulting resource, but also your own knowledge, you'll start to understand these reports in more detail.
Gotcha. Thank you.
Okay. Does anybody need to breathe for a second, or are we good to kind of keep going? We're getting into the weeds of it here. But I think this is really important in terms of getting across the essentials of what you need to understand with your financials. And again, we're sharing the slides, we'll share the examples. If anything doesn't make sense later, or if you've got any follow-up questions once you kind of have another look at it, please feel free to reach out. So calculating your profit margin, and this kind of goes back to what Ray was saying before in terms of making sure that you've got all of the costs. And the most obvious example here in terms of have you got all of the costs is in that product side. So a lot of the time when people are thinking about how much has my product cost me, they're thinking about the raw materials or what it costs them to buy it from a supplier, okay? So there's two levels of profit that you think about, particularly in terms of products, or my example of a bookshop for previously. So your gross profit is what you can sell your thing at. So I'll use a book again. Actually, no, Time to Produce a hat. So what you can sell your hat at, you're going to sell your hat at $100. Then you've got all the raw materials that that you needed to buy in order to produce this hat. Okay, so it's going to cost you $30. And so if you think about your cash outlays for that hat, you might stop at the gross profit level, because you're like, well, it only cost me $30 to buy all the materials and the stuff that's going to go in the thread and the stuff that's going to go on my hat. So for every $100 that I sell my hat at, I should make $70. But what you've got to take into account, and my bugbear is your time, because a lot of people don't think about their time, and your time is important. So think about the time it takes you to produce this hat. So it might take you an hour, it might take you a day, but that time is not free. It might feel like it because you're not having to sit there and kind of pay yourself as you make your hat, but you've got to eat. And you've got to keep a roof over your head. None of these things are free, therefore your time isn't free. And then if you think about the cost of your equipment, you may have had to bought equipment to make your hat, and then your overheads, because you might have a workshop, for example, that you need to pay rent on. You've got to keep the lights on, you've got to keep the aircon or the heating going in your workshop. And all of that kind of starts to chunk down into what your real profit is for each hat that you sell. And as you can see, there can be quite an enormous difference between your gross profit and your net profit. So please, if there's one thing to kind of take away from it, never discount the value of your time, and always incorporate it into your pricing. Going back to the previous conversations, that may be where you decide to discount, or you may decide to, not value, but you may decide to be unprofitable to build your hat market share. But don't forget at the end of the day that your time has value. And then if you've got a business where it is quite raw material and intensive, or you've got a pre-buy, say your book inventory or your grocery inventory, you may need to buy a certain amount. No one's going to sell you the one bottle of milk that you're going to sell to your customer. You're going to have to commit to a certain volume in order to get that production in. So you may need to pre-fund that. And that's where, again, we kind of go back to the whole, cash flow versus profitability. I did also want to touch on services, how you cost out your services, because a lot of the time, yes, it might all be very well to say, you have to value your time, but how do you value your time? So the way that I encourage people to think about it is, if you think about what your target annual salary might be, for example, and I've used 50,000 here, you then need to work out how many days you're actually really going to be earning that money over, because, you could, but you don't really want to work every weekend and every public holiday and never take a vacation, never get sick, spend no time doing business development or doing other administrative tasks. You can't count all 5 days a week, 52 weeks a year as the number of days which you can work, even if you're full-time, okay? And quite a lot of people I see using these 260 days per year to work out their hourly rate or their daily rate. That may work when you're employed by someone. And so when you look in Xero systems, for example, that's actually exactly what they'll do, because they're going to pay you whether you're on holiday, whether you're sick to a certain degree, public holidays, all those kind of things. But when you're thinking about the days which you have as a business or an independent consultant to generate that annual salary that you're targeting, you do not have 260 days. So generally, I would think about between kind of 210 and kind of 230 days that's actually available to you as billable days. The reason why it can fluctuate is that unbillable time might be a bit of a luxury at certain points. You may think, well, I'm starting up a business, I'm going to take a full 4 weeks of annual leave a year. So you have some flexibility there, but I'd encourage you to make that number as low as possible, because, you will spend time building your business. You won't have every single hour that you devote, which will be able to be billable. And then out of there, you'll calculate your day rate from your 50,000 annual salary. And from there, you can calculate your hourly rate. And over here is why it takes you an hour to produce that hat, is what I've said. So that's how the two things kind of tie together.
Cheers.
Any questions? No.
I've got one, Michelle.
Yep.
So we got target annual salary as $50,000.
Yep.
How do we decide that? We want 50,000 or 100,000 or 80,000?
That's totally up to you. What do you need in order to service your life, essentially? Because we all have expenses, right? We've got rent, we've got mortgages, we've got to put food on the table. We might have childcare costs. We might have transport costs. We might be supporting dependents. We might want to go to the cinema a couple of times this year. Now we can actually do things again. It's completely personal choice.
So what I'm thinking it this way, I might want to go to an investor and pitch my business. They will obviously ask me this question: how much is the gross and the net profit I'm standing on?
Yeah.
So if I really want to be smart there, I might want to get my annual salary as low as possible initially, and then increase my net profit and show them this is what I'm earning, so they can do the higher valuation. Is that how it works?
It is. Valuation is very much an art, not a science. When you're starting out a business, sometimes it can be, there's two views, right? Sometimes it can be a negative to, particularly in kind of, these sexy tech businesses, to kind of show founders earning market salary, because frankly, they've got equity. That's their skin in the game. They should be earning something, but it certainly shouldn't be kind of potentially what they should be earning in if they were to kind of leave the business and do a corporate role, because they're betting on the long-term sustainability of the business. So what an investor wants to see is, have you got as much skin in the game as I have by putting money into your business? That's one view. Okay.
Mm-hmm. Okay.
With other businesses, so for example, what happens quite often when you're preparing your business for sale, for example, and it's not a sexy, techie, unicorny type business. It's a profitable, great, sustainable business that you want to retire, you want to sell it, but you've been paying yourself below market rate. Someone that comes in and assesses your business is going to look through, as one of the things that they look through, the salaries within the business. And if they see that the CEO is earning, who's running this, multi-site, multi-state, multinational business, is earning 50,000 a year, that's all they're taking from the business. The first thing they're going to do is replace that salary with something that's market rate and work out how profitable the business really is. So there's a few different lenses that you can look at that through. But I think from a practical perspective, picking that salary, you need to understand what your personal costs are that you need to sustain while starting this business, because that's the only way your business is going to be sustainable if you are covering your base requirements as a human. So you do need to take that into account.
Right. Cool. Thank you, Michelle.
Right?
Yeah, I just wanted to add to what you were saying. If they saw that you were grossly underpaying yourself, they are going to want to see that money is still in the company in retained earnings. That can be a positive. That says you're essentially reinvesting. If the money isn't growing in retained earnings, then you're not making enough to pay yourself more. And that's when your valuation goes down.
Got it. Yeah. This is where actually I was thinking, initially I might really not want to pull any salary from the business. I just really wanted to understand how is it really going to impact the overall valuation of the business, and for the longevity, what I will be doing. So that definitely answers. Thank you.
Cool. All right.
Michelle, sorry, just correct me if I'm wrong, but when it comes to valuation, wouldn't someone who is wanting to evaluate your company for the purpose of buying specifically, the gray areas are more where you actually put in goodwill and expected revenue and stuff like that. That's where you would kind of hype up the valuation, not necessarily onto the wages side of things or operating costs and stuff like that.
No, I'm not saying your salary changes the valuation directly, but say the business is being valued on a multiple of your profit, which businesses often are, they're going to look and see, is the number you're presenting actually the real profit number, or should it be lower because you're artificially inflating the profit by giving yourself a lower salary? Does that make sense?
Yeah. So essentially, if I had to kind of just continue on to the analogy that was given earlier, if I had to be that shifty guy, if I had to kind of bump up my valuation, I would be looking at the non-tangibles and the perceived values of the businesses rather than anything to do with operations or anything to do with cost of services or cost of products or purchase.
I don't know whether that's quite the right way to look at it, because I think certainly the intangibles around the business, and there you're talking about things like your brand value and your forecast trends and all those kind of things. It's not being tricky. I mean, that is a real value to the business, but both things will come into play.
All right, gotcha. Thank you.
Yeah, because just to continue on that a second. For example, if you're a business that has built up a really valuable kind of customer base and user base, when someone's looking at the value of that business, another metric that they sometimes use is the value per user or the value per customer, and particularly, and we're probably getting a bit more into the weeds of it now, but I quite like this area. That if someone's looking at buying that business and they're a strategic buyer, those customers themselves may have enormous value to a potential buyer that isn't reflected in the financials of your business as far as the trading financials are concerned. But I could talk for hours about that, so let's not go down that.
Sure. I mean, I asked that question because of a recent merger that I was looking at. Was done for Cytless. It's an American-based company, and it was an assetless company to say the least. But it was evaluated at close to $4 billion and eventually sold at $7 billion.
Or the motorcycle came over at the key figures.
So it was more to do with the customer base itself, that all they had in terms of the major things to show. They were an assetless company, so the evaluation came up to around $4 to $6 billion, and eventually.
That's not an assetless company. The customers are definitely an asset when it comes to a business.
Yeah, asset in the
if you think
traditional
about
sense,
how that those customers were acquired, that was both value of the product, skill in marketing, a whole bunch of things which have got them to that point.
Well, I certainly know I'll have to probably get in touch with you to evaluate my company. It looks like there are some really, really good ways to evaluate them.
Valuation is a dark art, right?
I agree.
Just to Tawfiq's point, things like the value of your customers as an asset doesn't show up in your balance sheet. You can't put it in there. What you do show it up, where it does show up, is in goodwill. And when you see a company sell for a premium over the book value, which is what the assets minus liabilities says you're worth, the difference gets accounted for as goodwill. And that's things like customer loyalty, or what build that value that makes people willing to pay a premium over the book value.
Yeah. Cool. Yeah. I might just park that one there. But if you've got any other questions, feel free to hit me up over email or message after this. I'm just a little bit conscious of time. We've got 15 minutes to the hour now, so I'll try not to speed through the rest of it too much, but I might just need to speed up a little bit. So, funding your business. A lot of businesses are cash flow hungry when they first start out. There's going to be costs that you have to fund straight out of the gate, whether that's things, setting up your business, buying inventory, investing in staff before you have revenue, all of those things, that needs cash. There's a variety of ways in which you can raise those funds. The two primary sources are equity or debt. When we talk about equity, we talk about selling shares in your business. I'm talking about a company in this scenario, and you rarely get someone investing in a sole trader. They'll want to invest in a company. So the pros there is the risk is on the investor and the person providing those funds, which is why sometimes, when you're raising funds at an early stage, it's from friends, fools, and family, which is a little harsh, but fair given, largely unproved business models. So it's free to a certain extent, apart from if you get it from family, nothing's free. But there's no need to repay it. And usually no conditions associated with it, certainly not from a legal standpoint. However, it can actually, if you think about it, be one of the most expensive ways of raising funding because of what you're having to give away in terms of a proportion of your business for those funds. Do you think about the value of your business will grow from, I don't know, $10 to $10 million over the course of a few years, because we're all going to have very successful businesses. So if you give away 10% of that business when it's $10 and you give it away, you get $10 then, that $10 has bought that person $1 million at the end. So it can be very expensive. And what people find as they raise funds, as they go through different iterations of the business, you quite often, hear these massive valuations, these very successful businesses that have sold out. The founder might only own 10, 20% of that by the end of all of that is actually owned by now, majority owned by all the investors that have put money in through the early stages. So it's just something to be aware of. Debt.